Today I would like to analyze Warner Bros. Discovery, one of the major streaming companies in the world, and I think they have a very interesting portfolio of movies and series. As we can see here, some of the movies, Superman, Batman, Big Bang Theory, one of my favorite series actually. And I think it's a very interesting company as well. If we take a look at the chart, we can see we are down 64% in 5 years. And from the high in 2021, it's close to 86%. So it's looking very bad actually at about the stock price. And if we take a look at Netflix, it's doing quite well, 183% in the last 5 years. So it's very interesting. We're going to take a look at the financials to find out if it's a buy right now. The first thing we can recognize is the market cap of 25.10 billion US dollar. This is the current stock price multiplied with the shares outstanding. We can see here it's already a huge company, but compared to other companies in the entertainment industry, there is still enough room to grow, especially if we compare it with Walt Disney, 204 billion US dollar market cap, and Netflix around 418 billion US dollar market cap. The first thing we are looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So we can see here in 2019, we had around 5% revenue growth, 2020 around 4% revenue decline, then 2021 around 14% revenue growth, and then in 2022 we had 177% revenue growth. So why this is not really important? Because this is mostly because of the merger of two companies. So we had Warner Bros. And Discovery making the mergers. So this is why the revenue did grow so much. So we cannot really consider that. So the next thing we can consider is 2023 with 22% revenue growth. And now in 2024, we have the revenue decline around 6%. So overall, what can we say? I would say it's a revenue growth in the last 5 years. But we also have to consider that the revenue is declining now in 2024. And I think it's mostly because the cable TV is not doing so well. Less people watching TV right now, and they own a lot of channels on the TV. So we have to consider that. For me, it's still a check. I would say they had some good revenue growth in the last 5 years. The next thing we're looking for is free cash flow growth in the last 5 years. This is very important because the free cash flow can be used to pay back the debt, to pay the dividend, to pay the stock buybacks, and also to invest in the business. So we can see here in 2019, the free cash flow was around 3.11 billion. Then we had around 25% drop in 2020, probably related to COVID. Then we had around 4% increase in 2021. Then we had the 36% increase in 2022. And then we have the 85% increase in 2023. So we also can take a look at 2024. We can see here it's around 5.3 billion US dollar. So we have a decline again. So overall, I would say it's a check here. We have a free cash flow growth in the last 5 years. So this is something we like to see. The next thing we're looking for is free cash flow yield over 4%. This can also tell us about the valuation of this company. If it's under 4%, it could mean the company is overvalued right now. So what we're going to do is we're going to take the free cash flow in 2024, around 5.3 billion. Then we're going to divide it with the current market cap around 25.10 billion. And then we're going to get the free cash flow yield for 2024. Which is around 21%. So this is a very strong free cash flow yield, and I think it's very rare to see that. So there will be other reasons why this company is so undervalued right now. So it's a check here for me. Now we're going to take a look at the balance sheet. We would like to see the debt to free cash flow ratio under 5. This means the company can pay back the debt with the free cash flow in under 5 years. This is very important because if a company has too much debt, it can risk to go bankrupt, and we don't like to see that. So what we're going to do now is we're going to take the short-term debt around 3 billion. We're going to add the long-term debt around 37 billion. Then we're going to divide it with the current free cash flow around 5.3 billion. Then we're going to get the debt to free cash flow ratio around 7.54, which means around 7 years and 6 months it takes to pay back the debt with the free cash flow. So it's not a check here, and it's not a great number. It means the company has a lot of debt. But we can also see here they try to pay back a lot of the debt, the long-term debt decreasing. And this is a good thing. I think it's very important for this company to pay back a lot of the debt, because we can see here the interest expense in 2024 was around 2 billion. So they pay a lot of interest for this debt. This is not good. It makes the profit less. And we're going to take a look at the cash on hand as well. We can see here around 3.5 billion. So this is a good number. I think this company can do very well if they can pay back the debt in the future. And if the interest rate goes down again, this is also very good for this company because it has a lot of debt. The next thing we are looking for is shares outstanding decrease. This means the company buys back their own shares. We would like to see that, especially if we think the company is undervalued. But we also have to see, because if a company has too much debt, it doesn't really make sense to buy back their own shares, because it can risk the company as well. So we can see here, it looks like in 2019 and 2020, they did buy back their own shares, close to 1 billion in 2020. So we can also see that here, 2020, they did buybacks. Then in 2021 and in 2023 and 2024, the shares outstanding increase. This means they put more shares in the market to get their own money up. So it's not a check here, but I think it makes sense because this company has a lot of debt. They should not buy back their own shares. So it's a good thing that they're not doing that. I would like to give my conclusion about this company. So let's start with the positive. So they have a very high free cash flow yield, around 21%, which makes the company look undervalued. But they also have a high amount of debt, around 40 billion. So this company has a lot of debt and they pay a lot of interest on that, around 2 billion interest expense per year. So the question for this company is, can they do well with the streaming service in the future? And they have a lot of movies and a lot of series that are still popular. So I think if they can keep going in this direction and make new movies and new series that people like to watch, I think they can do quite well, especially if the interest rate go down in the future. I think this company can do better in this time. So for me, around $7, I think this company looks very undervalued. Even right now at $10, it can look undervalued. But if you want to make sure, I think around $7 is a good buy. And I think this company is very interesting. If they can keep the debt down in the future, this company can do quite well, in my opinion.